This video covers break-even analysis as part of the cost accounting unit. Break-even analysis is used to determine the number of units of a product that needs to be produced and sold in order for the income generated from the sales to equal the cost of manufacturing. At this point, the business will neither make a profit nor suffer a loss. The business is said to break even at this point. This point is therefore known as the break-even point. So the income from sales is exactly equal to the manufacturing cost. So income and cost is balanced. Let's look at an example. We have a selling price of 50 Rand per unit, a fixed cost in total of 120 Rand, and then the variable cost is 20 Rand per unit. So let's draw up a table by trial and error to see how much profit we make for the various quantity of units that we may produce and sell. So if we produce and sell one unit, we know the selling price is 50 Rand per unit, so we will get 50 Rand. We know our fixed cost is 120 Rand. The variable cost per unit, it's 20 times the number of units. 20 times 1 is 20. Our total manufacturing cost is the fixed cost of 120 plus the variable cost of 20, which is 140. So we have sales of 50, we have total costs of 140. 50 minus 140 is negative 90, so it's a loss of 90 Rand. Let's see, if we produce 2 units that we sell, 50 Rand times 2 is 100 Rand for the sales income. Fixed cost stay is 120, it's a constant. Variable cost is now 2 times the 20 Rand per unit, which is 40. Total manufacturing cost is the 120 fixed cost plus the 40 variable, which is 160. So now income of 100 minus cost of 160 is a loss of 60. If we produce 3 units and sell them, we have 50 times 3 is 150. Our fixed costs remain constant at 120. 3 times 20 per unit is 60 Rand for variable costs. The fixed costs of 120 plus the variable cost of 60 gives 180. So income from sales 150, subtract total manufacturing costs of 180, we make a loss of 30 Rand. If we produce and sell 4 units, it is 50 Rand per unit times 4, which gives 200 Rand. Fixed costs stay constant at 120. 4 units times 20 Rand is 80 Rand. The 120 Rand fixed cost plus the 80 variable cost gives a 200 manufacturing cost. And now our income from sales is equal to our total manufacturing cost, so we don't make a profit or a loss. If we sell 5 units, it's 50 Rand times 5, which is 250. The fixed cost stay constant at 120. Variable cost is now the 5 times the 20, which is 100 Rand. Fixed cost plus variable cost is 120 plus 100, 220, which gives total manufacturing cost. Sales of 250 minus costs of 220 gives a profit of 30 Rand. And then if we produce 6 units and sell them all, it is 50 Rand times 6, it's 300 Rand income from sales. Fixed cost stays constant at 120. The variable cost is now the 6 units times the 20 Rand per unit, which results in 120 Rand. Total manufacturing cost is the 120 fixed costs plus the 120 variable, which results in 240 total manufacturing costs. The 300 income from sales minus the 240 total manufacturing cost results in 60 Rand profit. So from the table we can see that the break-even point occurs when 4 units are produced and sold. Now we don't make a profit, neither a loss. At this point, the income from sales is the 50 Rand times 4 units is 200 Rand. And the manufacturing cost is the fixed cost of 120 plus the variable cost of 80, which is the 4 units times 20 Rand per unit. So in total it results also in 200 Rand. If less than 4 units are produced and sold, then the business will suffer a loss. While the business will make a profit when the production and sales is more than 4 units. So let's do a calculation of the break-even point. The following steps are used to calculate the break-even point. Step 1. Split the costs involved into the fixed and the variable costs per unit. Calculate the difference between the selling price per unit and the variable cost per unit. This amount is called the contribution, since it's the amount that is contributed towards covering the fixed costs from each unit that is sold. So it's basically the selling price minus the variable cost gives the profit per unit, and that profit we need to see how many times it goes into the fixed costs, because how many times it goes in the fixed cost will be the break-even point. So third step is therefore to divide the total fixed cost by the contribution to get the break-even point. So if we think back of our previous example, the fixed cost was 120, the variable cost per unit was 20 Rand. So to get the break-even point, we first have to calculate the contribution, which is the selling price per unit, which was 50 Rand, minus the variable cost per unit, which is 20, which gives us a contribution of 30 Rand. So we now have to see how many times this contribution goes into the fixed cost of 120 Rand. So the fixed costs divided by the contribution, we have a fixed cost of 120 Rand, we have a contribution of 30 Rand, 30 goes into 120 4 times, so we get the same result as per the table.